Welcome to Diagnosing Health Tech, where we talk to some of the brightest minds in healthcare about making healthcare friendlier, safer, and more effective. Sponsored by Healthcare Strategy Bullpen.
Good morning. My name is Jeff Englander. I'm the founder and principal of the Healthcare Strategy Bullpen. And I'm also an executive advisor for business development for Clearwater Security. And welcome back to Diagnosing Health Tech. It is my pleasure to welcome Stephanie Davis to the show. Stephanie is an award-winning industry analyst in healthcare technology and distribution, with a 15-year career as a Wall Street analyst and associate at such wonderful firms as JP Morgan, Citigroup, SVB Securities, Barclays. She is now an advisor to health techs and often speaks at public events and on panels. Stephanie and I were just down at the Kennedy Ventures or K Ventures Lion Forum on Cape Cod, and Stephanie hosted 2 panels there, and we had some wonderful discussions. So welcome, Stephanie.
Thank you for having me on the program, Jeff.
So, Stephanie, one of the things that we've talked about a lot as we've gotten to know each other is healthcare entrepreneurs or entrepreneurs in general have this kind of fantasy that they have this great idea that they're going to change the world, and in this case, change healthcare. And they're going to get funding for this, and then voila, the magic's going to happen. But that's not really the reality of how this all works. So can you talk to us about, how this kind of plays out a little bit in your experience, and maybe some of the things that people should know as they kind of, for lack of a better term, get smacked in the face by reality?
Well, it's one of those things. I like to think about the tech disruptors that get into healthcare, right? They start in there, they call me and they say, what a nonsense industry. We're going to disrupt healthcare and we're going to change everything. And then inevitably, a year later, I get a call and say, wow, this is a really slow moving industry. And so I think the idea of healthcare disruption, you always have to remember that there's a lot of incumbents within the space and that they are incumbents for a reason. Maybe they're the fabric of how healthcare works, or they make sure how payments happen. And so you have to think about all the different end components and kind of where you can fit in and who you can disrupt and who you can maybe work with. It's very, very hard to go it alone in the industry.
And what about, as you start to, build the company, as you say, it's very hard to go it alone. We've seen and we've talked about, you see a lot of people who are of a technology background and they see an inefficient process in the industry. And then, they try to fix something. But they don't understand the intricacies, what I like to call the nooks and crannies, thinking of the old English muffin commercial of healthcare. How do you, kind of deal with that?
Everything in healthcare is broken in such a way that moving one piece will end up breaking a bunch of other little pieces, which is what I think is often what people don't appreciate. It's not to say that disruption is wrong, right? Look at telemedicine. That was a concept I remember when it first came out, when Teladoc was coming public, actually. The biggest knock on it was that telemedicine was illegal in the state of Texas. That's a great bear case. How do you argue against that? Yes, it's not legal. But it was something that they had to move around, some of this kind of older regulatory bits that made less sense in the current day and that you could actually find a way to work around it. I think the biggest risk is when you're trying to go and work around whole players. PBMs often come to the focus, right? Moving around PBMs, but moving around the payer, right? Direct contracting. These are the things that end up being a little bit more sticky as concepts. I think it's tougher if you're a, smaller, scrappy institution to really compete in that.
Interesting. And so, on this journey, as the tech players are starting to move into the industry, and as entrepreneurs are starting to move into the industry, what are some of the things they don't think about, but that they should? One thing that comes to mind that I talk to a lot of people about is, project management, change management, emotional intelligence in terms of the ability to move things and people along. What are your thoughts on that?
Oftentimes, especially people that are coming from more tech world, there's this ethos of move fast and break things,
Yes.
right? That is, you have to think about the downside risk in different industries and why it works maybe in software or maybe in social media and less so in something like healthcare. The downside risk is someone dies. Right? No one wants
Yeah.
that outcome, and that's something where I think there's a lot of slow-moving parts of healthcare and maybe a lot of kind of larger institutions that are a little bit more risk hesitant, and that is because they know the downside risk is the worst risk possible. Um, it's also I've always thought this was interesting. In technology, there's a lot of, winner take all or, direct competition, kind of like fierce personalities and dislikes within the industry. I think in healthcare, because there's so many niche components of it and there's so much need, it actually makes a lot more sense to collaborate with some of your peers, or I always call it like co-opetition. The frenemies dynamic is pretty important in healthcare.
And where have you seen that play out?
And if we want to continue on the telemedicine trope, I think the idea of collaborating with the payers instead of having the payers go it alone made a lot of sense. Same thing, then collaborating with the hospitals. I mean, being payer led and being hospital led is really two opposite sides of the coin. And I think a lot of folks ended up doing that either way.
Right. Okay. And, as we start to think about,
Actually, I
you
want to add to that.
go ahead, I'm sorry.
There's like a network component, right? I think a lot of things, data sales is a great example of this. I think a lot of the different EHRs realized they had a ton of clinical data that was captured in their solutions, and they wanted to go monetize it and sell it to pharma. It doesn't make a ton of sense for everyone to build their own pharma-facing sales force. It is incredibly expensive to do that, and there's a lot of dyssynergies to it. And so you've seen Veradigm and Athena, for example, they collaborated in order to have a consolidated pharma-facing sale. Things like that, where someone's already built a channel, it kind of makes more sense to work together, even if you go head to head in a lot of different deals.
Yeah. So as, just kind of to get back to our theme of, the idea, growing it, hit in the face with some of that reality. And then as you start to think about, okay, do you go public? Do you stay private longer? Um, you know, what are some of the to-dos that companies don't think about, before they go public, or they think about even staying private longer, that are not as obvious? You and I talked about messaging. Are there other things like that and other ways that they want to think about, what are the pros and cons of either going public or even raising additional private capital?
Like, I should write a self-help book. So you wanna go public, right? Make sure people
That
know
sounds
what
like
they're
a
getting
great
themselves
idea.
into. Look, I think the number one thing I ask every founder when they're going public is, "Why do you want to go public?" And you would be shocked at the number of people that have a very pregnant pause after I ask that. I think a lot of folks view going public as, you come up with this great idea, you get seed funding, you get
Yeah.
VC funding, and then, you IPO and then greatness and beyond. But the reality is, it's just another way to get funding. And it's a way to get funding that has a lot of puts and takes. Yes, you get a bunch of dollars, but the other hand, your investment spend, your strategy, your roadmap, all of that may then have to take a more linear path after you come public, as opposed to the moonshots that are harder to defend that you can
Yeah.
take when you're private. Um, it's a little bit, this will age me. Do you remember the show Newlyweds in the early 2000s?
Oh God, yes.
All right. So going public is very similar to what they did. You can think of an IPO as having an incredibly public marriage on live TV and inviting the entire world to then watch your every step every 90 days.
Yeah. You mean because of the public reporting and all of the earnings calls and everything else?
Yes, I mean, you get this validation and you get credibility, which is wonderful. Everyone knows your name, but all of your missteps are public. You have a lot of different constituents to go and answer to. Some of them may not be longer term shareholders. They may really focus on the next 90 days and that's it. And you'll get different folks voicing their views on what you should be doing based on their views on how long they're invested.
And how does that differ from like, what kinds of things should people be attuned to that, maybe, venture capital or growth capital investors might be more interested in?
I think when you especially when you have a strong VC backer, your problems are their problems. It's almost more of a collaborative sort of thing. You can sit with them and say, "Here's where we are. The market has changed. This is what we're thinking. Can you help us? How can we position the company to best succeed 5, 10, 15 years down the road?" If you're a public markets investor, you may not be thinking in a 1-year increment. And so there's definitely a difference in what the company should be doing. Maybe they're going to emphasize a buyback in order to go and raise near-term stock price, if not really help the company strategy longer term. Um, Maybe there could be some activism where they can make some more significant changes in your company if they're able to gain a big enough share.
Right. And you and I also talked about some of the risks that going public exposes a company to. We talked about cybersecurity, but there's certainly the
Yes.
risk of, market, I don't want to say hysteria, but that's probably a good term, and change in
Mood swings.
valuation. Look at what happened, post COVID and 2021 to now. It's a much tougher environment to raise money. It's a much tougher environment to operate in. How should companies think about that?
Well, the market does have different sentiment swings, and it can be more rapid than I think your private market investors will have. I remember as we saw interest rates rise post-pandemic, all of a sudden, every company that was told, "Grow at all costs. Are you gonna grow 30% or 40%?" All of a sudden had investors asking, "Where's your EBITDA? Why
Yeah.
are you adding back stock-based comp? Isn't that a real expense? Where is your profitability and what's your path there?" I heard a lot of frustrated C-suites tell me, "Why are they asking that? They just told me they wanted something entirely different months ago. This makes no sense." I think there's also the harsh reality that if you're a public company, your investor dollars are coming in and their alternative is literally every other public company available. And so Teladoc saw this. You could be the same company you were in 2020 versus 2022, and you could trade at a very different multiple.
Well, when the markets were hot and frothy, everybody was ARR, ARR, as we were talking about. And then when interest rates got up, everybody, as you said, were like, okay, I want EBITDA and I want to know what your sustainable business model is. And there were a lot of cutting. That can take a little bit of time. How do you coach the CEOs and senior leadership teams that you're working with how to navigate some of that? So you have time to make a plan and you have time to execute on that plan, to go, from a growth at all costs to a, more profitable EBITDA model.
I think it really depends if you're public or private. If you're a public company, the advice I would give is it's going to be very painful, year to 2 years, and you're just going to have to take your medicine and, come clean about this is where the market is looking for, this is what they're demanding. I think there's a certain level of cuts you can make without really destroying the business model and accepting that maybe the stock just won't work as well. Um, Being on the private side gives you the luxury of no one really seeing all of your financials on a 90-day basis, or a very select group that's on your side seeing those financials on a 90-day basis. As a result, I mean, don't lose sight of your strategy, but unit economics matter. I
Yeah.
think, if anything, the fact that unit economics didn't matter for a good chunk of recent history in health tech was an anomaly. It's never the norm.
Yeah.
ZERP is highly irregular. And so I remember working on IPOs where my biggest pushback was how do your economics ever work? Companies not to be named. I think that's such a core part of investing properly, never mind business model creation.
Right. So would you get back to the fundamentals of unit economics, lifetime customer value, customer acquisition cost? Are there other things that you would focus in on?
I mean, unit economics, LTV to CAC, all of these things are very important for a reason. It's something that you should be making sure that your business model passes that sniff check before you even wanna go and raise. I get that there's always going to be scaling up, and there's going to be a lot of spend in the initial components of it, but if you're starting at a very bad gross margin, for example, you have to ask, what is your ultimate business model going to look like? Is there a way to improve this, or is this just something where structurally you're never going to get beyond, a few percentage points of margin, in which case, should this be a standalone business model?
Yeah, that's great. Well, thank you so much, Stephanie. I really appreciate your time. Everyone in the crowd, if you want a wonderful speaker who has encyclopedic knowledge of the industry, you can tell from some of the references she made in the podcast, and really, has a super grounded look, wonderful things to impart to your guests. I highly recommend Stephanie. I've seen her speak a number of times. So I highly recommend her. I hope everyone enjoys the podcast. Would love to have you back as the industry evolves, Stephanie. As I said, I'm Jeff Englander. I'm the founder and principal of Healthcare Strategy Bullpen, also an executive advisor for Clearwater Security. At the Healthcare Strategy Bullpen, we help providers and payers adapt and deploy healthcare tech to improve the lives of patients. We help healthcare innovators be more effective in developing and deploying their technology to improve the healthcare delivery ecosystem. Among some of our focus areas are operationalizing data to maximize its analytical value, demonstrating the benefits of new applications enabled by digital health, applying digital health to high cost and chronic conditions, engaging and managing the practical, cultural, and technological issues around SDOH. And obviously at Clearwater, we also help people work with deploying cybersecurity and helping cybersecurity become a competitive and strategic asset as opposed to an issue that impedes their growth. Please follow us on LinkedIn and on our website, healthcarebullpen.com. Thank you so much, and please join us again for the next podcast.
Thank you for having me on.